This is our Forex trading blog for January 28th, 2011. One of the first things we look at each day is which currencies have the strongest weekly and monthly trends, and is today's statistical trend in those currencies going in that direction or against it. If you have a currency that's weekly and monthly trend is very strong, and today's real-time strength is strong, that currency is more likely to continue trending that way, and it's more likely to give you more than an average amount of pips. In other words, if you're trading with the longer term trend and the real time trend is also in that direction, you have a good chance of catching 20, 50 pip moves. If currencies don't go one way forever, you can have a weekly trend be super strong and it's been going up for 3 or 4 days or multiple weeks in a row, and eventually there's nobody left to buy and it has to come down. So you can see that actually in the euro today. A little bit of weakness here, and again at 6. The weekly and monthly trend are very strong in the euro, but today's a pullback day. Just like the yen, extremely weak, and you can see if you scroll back to this yesterday, extremely weak trend. There was a real-time trend that went in the direction of the weekly monthly trend, and selling the yen yesterday was an easy trade. When currencies are doing counter trend, you don't know if you're going to catch 5 pip move, 10 pip move, 15 pip move, have a loss, or have a break even. You just don't know. It's much harder to trade, when that's the case. Now the CAD today, you can see the weekly and monthly trends down, and it was having mostly weakness today. The yen, however, the weekly and monthly trends down, but it was having a lot of strength today. So the CAD yen, weak CAD, strong yen, you have to sell it, but the yen is going against this longer term trend direction, so you're more likely to make less pips. That's just pure common sense. But let's take a look at that currency. Weak CAD, strong yen, and you can see currencies, once they break underneath the hourly, more likely to go down. Currencies that go above the gray hourly line in the middle, this is part of our containment band indicator, are more likely to go up. So you can see this one kind of was going sideways, broke down right here. You might have gone short with your stop above the high. It went sideways here for a little bit. I probably would have got out. I use a time stop, 20-30 minutes or hour max. If it doesn't start to go my way, I usually just get out because I can just get back in again if it pulls back. So I would have shorted this again right here, sideways rectangle breakdown, and you can see it kind of went down a little bit. Counter trend buy signal right here underneath the lower containment band, not much weakness. You get out of the trade. And then on this pullback right here, you want to sell the low of the sideways range. It never breaks down. Comes back up again, kind of runs out of steam right here, and goes sideways for about an hour and a half. You go short right here, and you can see this move went down about 70 pips. Because of the extreme weakness, you might have sold right here. That trade didn't work. You might have made 5 to 15 pips or broke even on it, and then you sold this pullback area right here. Again, notice no weakness on the way up, extreme weakness on the way down. Initially the CAD wasn't that statistically weak, but it became super weak later in the day, which our currency meter showed you. Not only that, but the yen that was strong before midnight had a brief amount of time where it was weak too. You don't want to sell two weak currencies against each other, but as of 7 o'clock right here, it became pretty strong, and that's when the CAD yen really took off to the downside. Look at that right here. Counter trend move here, and eventually you got in. Fib levels very likely to be a profit target. Let's look at some of the other ones. Today, at 7 o'clock, the euro was super weak, and the yen was extremely strong. So you could have sold the euro yen. Now keep in mind, this is going against the longer term trend. The euro's weakness is going against its longer term uptrend. So, look for maybe 20 or 30 pips max profit. If you happen to get in one that just takes off, stay with it. Obviously today was one of those days. 7 o'clock, it showed extreme weakness right here. You might have gone short after it double topped right here on a tick chart. It went down a little bit, 20 pips, more than enough to the very minimum break even on that. And this is a perfect example of what I consider one of our two entry methods. We either get into trades on pullbacks, in other words, the market's extremely weak, it does a counter trend move, as soon as it starts down we go short, or in this case a sideways rectangle or square pattern. This minimum time for the sideways range is about 30 minutes to an hour. Anything over 2 hours is very high winning percentage. And again, we're going against a longer term trend, so your initial profit target would be around 53 here. You're risking 10 or 12 pips to make 25. Now in this case, like many times that happens, you don't just get out of the trade. If it went here and went sideways for a while, you would exit half your trade and trail your second half, but it just broke through there. The next fib level is down to here. It did kind of stall right there. I would have got out of half my trade, and usually the market's not going to move any more than another Fibonacci level past that first wave. Notice it went right to the pip, almost the exact pip, to 1.382 fib target, and that's where you get out of your second half. So you would have been short this currency here at 75, say, out half at 05. So you made 70 pips on the first half and 130 or so on the second half. Excellent, excellent trade, and the currency meter found it. You know, the euro was extremely weak. Notice 7 o'clock right here, 7 o'clock right here. When did the real move happen? Happened at 10 o'clock, 3 hours later. Now, sometimes the currency meter's really early into the move. Obviously, there was already a move down initially, and traders that were watching this currency, it was underneath the hourly, and so therefore more likely to go down. Last night we had an NR breakdown short right here. Anytime that happens and the price breaks down through the low and the price is underneath the hourly moving average, you go short. That trade led to about a 20 pip move, and then it went sideways for many, many hours. Trends that are underneath the hourly, the first time it touches the hourly moving average right here, usually that's a great place to go short. You can see there is no statistical strength. If it shot up there with incredible strength at or near our dotted white line, you might not have wanted to take that trade. You probably would have got short here, probably broke even on it, had to get back in 5 minutes later right here at 42, and probably would have got out of this trade, you know, at the lower containment band right here around 81 when it went sideways. Because of this extreme weakness, this is our trend explosion system, these are very likely to continue to trend. However, the weekly and monthly trend's up, so you got to be really careful. If you got into a trade here, be very careful and take a small loss if that was the case. You got back in it again here, or if you avoided that one, you know, you made a huge profit on that last move. Another one that was very strong today that has an extremely weak weekly and monthly trend is the Australian. Now, at 1 o'clock, 12:30, which was one of the weaker pairs. It appears that the CAD was, and the CAD had a weekly and monthly trend that was down. This one, a little bit of weakness here that quickly went strong. So let's look at buying the strong Australian versus the weak CAD. The Australian CAD is very likely from 1 o'clock onward to give you many opportunities to buy. Now here's 1 o'clock right here. Notice it just broke from underneath above the hourly, which is one of our methods, and it's also been going sideways for quite a while. You might have bought this currency right here, and it went up and kind of went sideways. I would have got out of the trade there, and then would have had to re-enter it when it broke out right here. 10-day moving average, weekly pivot, and 20-day moving average are right above us. Major resistance, very likely to be the end of the move. So you buy this breakout and exit half your trade here, and your trailing stop would have got hit right here. There wasn't that much statistical strength, so I wouldn't have been buying this pullback and this pullback. But once it broke above the highs and all this resistance area, probably right above the weekly pivot level, you go long again by buying, and you draw your fibs on it. And this is your profit target up here. There's no other resistance except for the fib targets up here. And so, it kind of stalled right here, a few pips underneath that. I would have got out of half my trade right around 06 to 04. The trailing stop, when it's above the upper containment band, rarely do currencies go beyond the 1.618. So if it does and starts to come back down, look to get out somewhere up there near the high, especially when it's above the upper containment band. Statistically not likely to go too much further. Maybe you got out of that trade at 26 on the first half, or the second half, and 07 on the first. So you might have made 15 pips on the first half, 30, 35 pips on the second half, and the first trade, barely even 10 pips. So it doesn't always, the initial move isn't always the strongest one. Sometimes it is, sometimes it isn't. You got to take every trade. If you have major resistance above it and it doesn't have that much statistical strength, you might want to, get out of that trade here and kind of wait and see when it finally breaks out, get back in it. The euro dollar is a currency that has been up seven plus days in a row. And so we're looking for counter trend trades on this. When this broke down last night here, you might have gone short. You would have only made probably 15 or 20 pips. When it came back and tested the hourly, wasn't able to get above it, and our IntelliTrend bars went short. That led to about a 25 pip move. There wasn't that much weakness, and again, you're fighting the longer term trend. When it came back again here, you'd look to go short, but the price broke above the hourly, so you can't short it. Plus, look at how dark green the color is. The darker the bars, the stronger or weaker it is. Dark red is super weak. Light red is barely weak. Same thing. This thing came up, double topped right here. Aggressive scalpers might have gone short here where this is your profit target. And once it broke underneath the hourly right here, you might have gone short right here, pulled back a little bit from 07 all the way down to 84. More than enough to exit half with 10 or 15 pips, move your stop to break even, and then it came back to the hourly and again couldn't get above it. As soon as it breaks down underneath that bar's low, you're short somewhere around 04. And here's your profit target. If it stalls there, you want to exit half, but it didn't. It kept going down, kept going down. You know, here's your next profit level. It's underneath the lower containment band, very likely to stall. And when it kind of runs out of steam and starts to go up, I would have got out of the trade somewhere around here at 28. That trade, it's about 80 pip move. And anytime you have extreme weakness like this, usually on a counter trend move, you might, those trends are likely to continue. So I might have shorted right here, lost 5 or 7 pips, got short the next time and made 25. Small losses, big wins are really the only secret to trading. This one has a weekly trend that's down, so when it was kind of going sideways right here and rallied up with almost no strength, you might have gone short. Usually you want to wait for a pullback at the hourly. If it stalls there and starts to go down, you go short. But this one exploded up. Usually you can short the upper containment bands if the longer term trend's down. I focus on the middle one, which is the weekly. In this case, the monthly trend is up pretty strongly, so I probably myself wouldn't have taken that trade. When it pulled back right here, kind of consolidating at the hourly. When it finally broke down, I probably would have gotten short here, lost a few pips, 5 or 10, gone short the second time, and made 40 or 50. You can't make money if you're not in the market, and not every trade's going to work. You got to get in. If things are looking like they're not working, take 5 or 6, 7, 8, 10 pip loss, 12 pips max, and re-enter. Even if it's 5 minutes later, 2 minutes later, you got to re-enter. Or the other alternative is to have a much wider stop, maybe above this sideways consolidation right here. And the wider your stop, the tinier the number of lots you can trade. If you are risking 2% of your account per trade, you have a $1,000 account, you can risk $20. That means with a 10 pip stop, you can take 2 mini lots. If you double the stop to 20 lots, you can only trade 1 mini lot. So if you want to have probably a higher winning percentage, have a wider stop and just trade smaller lots. That's one way of doing it. I prefer to myself get in trading larger lots. You have to get out with tiny lots or losses when you're trading bigger lot sizes, and then immediately get back in. Notice this one, weekly and monthly trends down, broke the NR pattern right here. You would have gone short your stop above here, and that would have failed. You would have lost. And notice, it went up with very little strength, nowhere near the extreme level, and then it double topped right here with even half the strength. This is a perfect scalp. If you're a little bit more cautious and conservative, wait for it to break underneath the hourly and go short right here. In that trade, because you're trading in the longer term direction, I usually am a little bit more patient and hold the trades a little longer, wait for the fib targets to get hit. And it's the weakest it's been all day, but it's not at our extreme dotted 20 line, so you want to get out of your trade here. You might have gone short somewhere around 50. Out of this trade, maybe at 26, you made 25 pips. And that's the weakest it's been all day. So you look for a counter trend move, you go short, maybe you made another 20, 30 pips. Notice how the hourly moving average holds here. I would have gone short there. That didn't pan out. Maybe only would have made 3 or 4 pips. I probably wouldn't have sold the next time. Usually I kind of wait for a little bit more sign that it's going to go down if the first trade doesn't work. A lot of times they hit the hourly, barely pull back, and then they explode through the hourly. So for me, protecting capital is the #1 goal. I do miss trades that happen to double top right at the hourly, which occasionally happens. It's not the best trade in the world, but these fib levels I draw on the chart each day make excellent resistance And so that's this NR pattern right here. Normally you want to buy here because it's above the hourly and it breaks out and the weekly trend's up. But guess what? There's major resistance here. So you never want to buy. The number one secret I can teach is don't buy right in front of resistance. Don't sell right in front of support. You need 1.5 to 2 times likely profit versus what you're risking in number of pips before you pull the trigger. You know, you don't take a trade that might only give you 5 to 10 pips if you're going to risk 10 pips. That's just plain stupid. Don't do it. You know, this one has a weekly trend that's up, and when it finally came down here and consolidated, not improved to you, it's not going lower, you might have bought this breakout here. After a resistance area gets hit the first time, it's much more likely to get broken the second time, and especially the third time. But I can see this isn't the best trade in the world. Notice how this fib level here, once broken, becomes support. Unfortunately, the weekly and monthly trend's down, and you got all this resistance above it. But once it breaks through this resistance, buying this little pullback right here is a very high probability trade because, you know, it's working its way up, barely a pullback. This support level's holding. The next resistance area is up here around 50. So you're risking 10, 11, 12 pips to make a good chance at 20. And just because this is your estimated profit target doesn't mean it won't stop there or even up here. I would have probably exited half my trade right here at 60, and my trailing stop, you know, when it came up here and kind of ran out of steam, I would have got out of the trade up here around 80 on the second half. So the half the trade we would have made 50 pips, the other trade about 25 or 30. You know, a nice trade like that can get rid of a lot of 5, 10, 12 pip losses. And you know, a lot of trades turn out to be break evens because they move enough our direction that we move our stop to break even, and then when it comes down and hits the stop, we don't lose a penny.